School of Management Studies IGNOU presents an audiobook on the course MMPC-013 Business Law for MBA program. Block 4 Legal and Regulatory Framework for Financing and Investments of Business. Unit 7 Banking and Other Allied Regulation. Part 2.
Regulation in relation to the bank management. As was observed earlier that the law is concerned about the general character of the proposed management and as to how the affairs of the bank are conducted so that the public interest and the interests of the depositors are not affected. There are two aspects to this issue. One is who controls the bank, that is, the shareholding composition and the degree of control a body of shareholders can exercise. And secondly, issue comprises the quality of the management and its conduct. It is important for the banking company's depositors as to the distribution of the shareholding and the extent of the control that the dominant group of shareholders exercise over the bank. Part of the problem is taken care of by the BRA and part of the problem is taken care of by the conditionalities laid out by the RBI in giving the license and its powers to issue directions to the banks. First of all, the statute denies voting rights to preference shareholders irrespective of the fact that they have not been paid preferential dividend for 2 years or more. Secondly, even in the case of equity shares, no shareholder can exercise voting rights in excess of 10% of the issued equity share capital. This cap on voting powers can be increased by the RBI up to 26%. Thirdly, no one on his own or in concert with others can own 5% or more of the equity share capital or voting rights in a company without the prior permission of the RBI. In addition to these statutory restrictions, the RBI at the time of the granting the license lays down a schedule for the dilution of the promoter of the banking company. These are to ensure that individual interests do not get equivocated with the interest of the bank and there is a diversity of shareholding and voting power so that there is sufficient control over the dominant shareholder without there being a takeover which may not be in the interest of the depositors. Second limb of ensuring good management is quality of management and its conduct. BRA covers almost all aspects of potential control over the management and almost all aspects of a board of directors working which may affect the bank. The provisions may appear at some times to be repetitive. First of all, the BRA deals with the potential conflict of interest between the bank and its board. A banking company is forbidden to lend to any director or any person in whom the director may be interested in. Further, a bank may not remit any debt due from a director or any person in whom the director may be interested in without the prior permission of the RBI. This blanket ban on power to remit extends to extension of time for repayment or change in the terms of repayment. A person to be a director must not be a proprietor of any business concern or have a substantial interest defined by BRA in any company or firm or be connected with it in any form if it were not a small-scale industrial concern. The Act prevents a director on the board of a banking company to be a director on the board of any other company, even another banking company. The only exception granted to this ban is membership of the board of a subsidiary of the bank or that of a non-profit company. In addition, from a chairman appointed on a whole-time basis, directors to all employees of a bank, irrespective of whatever rank or office they hold, all are deemed to be public servants under Prevention of Corruption Act and can therefore be prosecuted for causing any loss to the bank by their corrupt actions. After dealing with the conflict of interest, the BRA deals with the composition of the board. Majority of the board needs to have technical expertise specified by the BRA with a further requirement of special knowledge and practical experience in the case of a whole-time chairman or managing director, and there can be only one of the two in a bank. What is important is the power of the RBI to interfere with the appointment process of the appointment of the board, the chairman, and the managing director. No amendment in the Articles of Association or Memorandum, no contract or resolution of the shareholders or the board of directors with regard to the appointment, termination, or remuneration of a chairman, managing director, director, or chief executive officer shall be effective unless approved by the RBI. Other than directors who are not whole-time directors, even the appointment, reappointment, or termination of appointment of the aforesaid managerial personnel requires the prior permission of the RBI. The RBI can ask the banking company to reconstitute its board if the composition of the board is not in accordance with the BRA. Non-compliance by the banking company of the direction would allow the RBI to remove the director or directors whose appointment is not in compliance of the law and appoint its own nominees on the board. In the same vein, in case the RBI comes to the conclusion that the whole-time chairman or managing director of the company is not a fit and proper person, it may require the company to change the whole-time chairman or managing director, and non-compliance with the direction would allow the RBI to appoint its own nominee to the post. This power is in addition to the power of the RBI to appoint when the said post is vacant for an inordinately long period. In public interest of the depositors, or for securing proper management of the banking company, the RBI can remove any managerial personnel, that is, chairman, managing director, chief executive officer, etc., or officer or employee from the office after following due procedure, and appoint its own nominee to the post. For the same reasons, it may also appoint additional directors on the board of the banking company, and also in consultation with the central government supersede the board of directors and appoint an administrator to manage the affairs of the banking company. It would be worthwhile to note that many of these provisions with regard to managerial personnel with suitable modifications are also applicable to cooperative banks. In the case of the public sector banks, which are governed by separate statutes by which they were formed or nationalized, the powers are exercised by the central government. Regulations with respect to ensuring liquidity and healthy lending practices. As discussed so far, the banking business is inherently fragile as it lends for long-term purposes on the basis of funds which are borrowed from short-term sources. Other than ensuring that the management should not be such that it may compromise the interests of the depositors, certain norms have to be in place so that liquidity is maintained and the bank's business is run in such a manner that it remains solvent. These statutory provisions came about in the background of historical experiences from some famous bank failures which the legislature did not want to be repeated. So there are certain no-go areas for the bank which the Parliament has itself prohibited or allowed a relaxation only with the prior permission of the RBI. As to the rest, it has allowed the RBI to give guidelines or directions taking into account the best practices in the world and the economic reality of India. First of all, a bank, in addition to banking business, can only do a business that is permitted by Section 6, Clause 1 of the BRA, though the last sub-clause of Section 6, Clause 1 allows the government to notify any other business or activity which a bank could engage in. What it cannot do directly, it cannot do indirectly as well. So no bank could have shares in excess of 30% of the shares in any entity not engaged in a business mentioned in Section 6, Clause 1 of the BRA. This restraint on shareholding is with reference to holding in any form whatsoever, that is, as an absolute owner, mortgagee, or pledgee. Pursuant to historical experience, a bank is forbidden to trade in goods and hold immovable property which is not required for banking business for a period of more than 7 years. In addition, as the ambit of a bank's permissible activities are also circumscribed like any company by the object clause of its Memorandum of Association, and any change in the Memorandum of Association of the bank requires the prior approval of the RBI. RBI can also caution or prohibit a bank or banks from entering into a transaction or class of transactions based upon its apprehensions. The reason for this comprehensive set of limitations is that the bank which has an opportunity to use the money parked by its depositors should limit itself to the business related to money lending and allied activities. Banks should not venture into a full-fledged business entity by itself, as then the chances are that the easy liquidity made available to it by the unsuspecting depositors may incentivize the management to take risky bets and suppress losses, and thus turning the bank in effect into a Ponzi scheme, satisfying old depositors by new deposits of the unsuspecting customers. Moreover, the drafters of the BRA were concerned that the interests of the depositors should not be made subservient to the interests of other creditors of the bank. In pursuance of this objective, there is a prohibition on banks in giving a floating charge on its assets to any creditor without the prior approval of the RBI. In addition to the restraints imposed expressly by it, the BRA gives rule-making powers to the RBI. Though BRA uses the term guidelines and directions for such rules made by the RBI, they are binding on the bank, though a lending decision in contravention of them may still be enforceable in a court of law. BRA recognizes that such guidelines may be specific to a bank or may be general, applicable to all or a class of banks or a bank. The RBI, when granting a license, may grant it subjected to conditions including conditions relating to loans which a bank can give, as it does in the case of small finance banks and payment banks. Then Section 21 of the BRA allows the RBI to lay down the policy for bank advances, generally for all or specific to a bank, including laying down the purpose, margins for a security, considerations for determining maximum exposures which a banking company can have to an individual, company, or group, as well as rates of interest and conditions for financial accommodation of a borrower. It is in pursuance of these powers that the RBI lays out the policies for social sector lending, syndicate lending for large ticket loans, prompt corrective action for weak banks, margin requirements for different types of securities including market securities, purposes for which no money could be lent, minimum interest chargeable and calculation of interest rate in the case of floating rate loans, etc. Even otherwise, the RBI, in public interest or in the interest of the banking policy or interest of depositors or for proper management of the banking company, may give general or specific directions to banks. It is in pursuance of this power the RBI has implemented the Basel Accord norms in India and given banks guidelines as to income recognition, that is, a frequent cause of bank failure, by suppressing its weaknesses. Also, NPA recognition and classification, debt restructuring of sick enterprises, and hauling the insolvent enterprises to the NCLT for insolvency proceedings. As per one of its directions, every bank should have a risk management committee to monitor the lending practices of the bank so as to ensure its stability. To handle potential liquidity crisis in a bank, even if it is well run, the law follows a two-pronged approach. The first is to prevent a sudden abnormal surge in the need for liquidity due to panic amongst bank customers, and the second approach is to ensure that the bank has enough investment in assets which can be considered liquid so that cash could be rustled up whenever the need for it arises. To prevent panic, BRA makes it a punishable offense any act which is designed to undermine the confidence of depositors in a banking company. Further, the depositors are automatically given a deposit insurance to the extent of Rs 5 lakhs to ensure liquidity in case of sudden demand, in addition to the lender of last resort role of the RBI under Section 19 of the RBI Act to the scheduled banks, that is, a lending done at the bank fixed rate by the RBI. Every scheduled bank has to maintain a deposit with RBI, which means a certain percentage fixed by the RBI, but at a minimum 3% of its time and demand liabilities. This cash reserve ratio helps in the settlement in interbank transactions via the RBI and also is an emergency liquid reserve available in an emergency. In addition to cash reserve ratio, the banks have also to invest a certain fixed percentage of deposits in assets which can be liquidated easily to raise cash, called statutory liquidity ratio. These assets are generally government bonds or bonds guaranteed by the government, though few other assets have also been qualified to be part of the statutory liquidity ratio. Subject to the floor and ceiling rates prescribed by the BRA, the cash reserve ratio and the statutory liquidity ratio is fixed by the RBI. In addition to these means to ensure liquidity, the RBI has also provided a repo window to the banks. Especially, a repo transaction is a short-term lending disguised as a sale and repurchase transaction between the parties. Securities are sold by the banks to the RBI with an understanding that they will be bought back by the bank after a specified period, usually a few weeks, at a fixed rate, which represents the price of original sale, and a specified interest rate called the repo rate fixed by the Monetary Policy Committee. Reporting requirements, inspections, and audit. It is important for the regulator to be aware of the health of the regulated entities. This is not just to see whether compliance is in accordance with the letter and spirit of the regulations, but also to allow a preemptive action to be taken to ensure that the regulated entity does not fail or its failure, if inevitable, does not pose a systemic risk. The three pillars of this regulatory awareness are regular reporting, statutory audits by trusted auditors, and inspections. In the case of banks, these three serve as an additional avenue of information in addition to what is gleaned by the RBI from the working of the payment system. The banks have to maintain the cash reserve ratio, statutory liquidity ratio, and a minimum of 75% of assets in India equal to its demand and time liabilities in India. These three ratios have to be regularly calculated at given intervals, so the RBI also needs to be informed about their compliance. Therefore, on the last Friday of every month, every bank has to submit in the given format data with regard to the liabilities and assets of the bank, along with any other information which the RBI may ask for. Further, under the RBI Act, the banks have to share with the RBI credit information, which is much more than advances made by the banks and includes information about guarantees, securities, and other potential liabilities which the RBI can share with other banks and express provision for sharing of such information was necessary because of the customary law that banks should maintain confidentiality about their customers' financial affairs. This was thought of as a way to reduce systemic risk. BRA now allows the RBI to publish any information received by it from the banks as well as any credit information disclosed under Credit Information Companies Regulation Act. This power should be read in consonance with the power given in the RBI Act, by which the information shared with the public should not name the borrower and the lender. The second limb of maintaining financial health through awareness is audit. While the company law provisions with regard to audit are also applicable insofar as they are not in conflict with the BRA. In the audit process of a company, the RBI has a certain control as it is on behalf of the depositors also interested in the audit process. The auditor, in addition to being deemed to be a public servant under Prevention of Corruption Act, has to be approved by the RBI before his or her appointment, reappointment or removal, in addition to following the Companies Act in such matters. RBI has a list of approved auditors. The RBI can also order a special audit of the banking company to be conducted either by the banking company's auditor or any other auditor appointed by the RBI. The auditors are also supposed to report on matters directed by RBI to be looked into, and the report of the auditors, normal as well as the special, shall be shared with the RBI. The third important pillar of this process to find the truth is the inspection powers of RBI, which it may do so on its own or shall do so on the directions of the central government. During inspections, not only the records of the bank will be scrutinized, but the officers and employees may also be examined under oath. Penal powers. Any regulator's powers have three components, that is, legislative or rule making, executive, and judicial, that is, power to impose penal sanctions. The third component is as important as the first two components because it is the third component, along with its expertise in the subject matter, which puts the fear of the regulator in the hearts of the regulated. What can be the penal consequences for non-observance of the regulatory guidelines and directions other than that of the change of key personnel, suppression of board, nomination of additional members on the board, etc., which the RBI can exercise or threaten to exercise to ensure compliance? At the first level, the RBI can deny the permissions which can be expected from it or deny the enjoyment by the regulated entity, that is banking company, of the general permissions granted to the sector. So as a disciplinary step, it may not sanction the renewal of a chairman or managing director's appointment or tell a bank not to open new branches under a general permission given to all banks. The second method of penalizing a bank is to forbid it from doing what constitutes the core of the banking business, a denial of which might mean a slow death of the bank. So using its powers to prohibit a certain transaction or a class of transactions, generally or specifically, it can impose restrictions on a bank on making advances or certain types of advances. The central government, if it is convinced on the basis of an inspection report by the RBI that the banking company's affairs are being run in a manner which is detrimental to the interests of the depositors, then it may prohibit the bank from taking fresh deposits. Failure to comply with cash reserve ratio may also result in the RBI prohibiting the bank from accepting fresh deposits. The third way of penalizing is imposing a fine on the bank and or its officers. So non-observance of the mandated cash reserve ratio and statutory liquidity ratio would result in the imposition of penal interest on the bank to the extent it is short of the required ratio, and in addition, the officers of the bank may be liable for fine calculated on the basis of per day the bank was in default. Penalty is also prescribed to those responsible for furnishing misleading information, not furnishing the asked for information, accepting fresh deposits in contravention of the prohibition, or contravening the provisions of the BRA. However, a court can take cognizance of the offense only if the RBI approaches it. The RBI also has the powers to impose fines on its own. The fourth way the penal consequence visits the non-compliant bank is the cancellation of license of the bank itself or of its branch. There are certain conditions which BRA requires for grant of license, as discussed so far, and in addition there can be certain conditions which the RBI may impose in granting a license. If these conditions are not being fulfilled, then the RBI may cancel the license issued by it. The fifth way in which the RBI may discipline the bank is by initiating winding up of the banking company. The RBI may make an application before the tribunal for winding up a banking company if it is convinced that the affairs of the banking company are being conducted in a manner detrimental to the interests of the depositors. Non-adherence to the capital requirements of a bank, non-compliance with the conditions of the license, prohibition from acceptance of fresh deposits, and non-compliance with the provisions of the BRA are also grounds for initiating such action in addition to the insolvency of the bank. The sixth tool to discipline a bank is by penalizing the shareholders without winding up the bank. The central government can acquire a banking company on the basis of a report by the RBI if it is in repeated violation of the RBI directions or the affairs of the banking company are being conducted in a manner detrimental to the interests of the shareholders. There is a provision for shareholder compensation for the expropriation, but no control premium is paid. In a similar vein, the RBI can reconstruct a banking company or amalgamate it with another after imposing a moratorium on the bank. Here, in addition to the shareholders, the depositors too may lose a part of their deposits or a haircut. Now let's summarize the unit. Regulation of financial institutions is extremely important because of the unique nature of a financial asset. It is an asset which derives its value by description, and its own existence is dependent upon the solvency or existence of the parties. Amongst all the players in a financial system, the banks are the most unstable of the lot because of their business model. Regulation seeks to reduce the risk of operation to the bank itself, to the banking system, and to the overall financial system and the economy. Since banking as an industry keeps on evolving and new risks keep on getting identified, and the relative importance of some of the old identified risks may get reduced, regulatory legal structure needs to be flexible enough to take into account the new challenges with alacrity. Indian regulatory structure for the banking industry tries to merge flexibility so as to take into account the global best practices and Indian reality with some certainties as to the considerations which will go into the rule making. Some provisions also seek to ease the hurdles in the smooth conduct of the banking business. Therefore, provisions for evidence by banks in Bankers' Book of Evidence Act, nomination in the BRA, and sharing of credit information under the RBI Act and Credit Information Companies Regulation Act seek to remove the landmines which are there in law in the conduct of banking business.
We were listening to the audiobook by the School of Management Studies, IGNOU, for MBA program. Course code MMPC-013 Business Law. Course Coordinator Professor K. Ravi Shankar. Voiceover by Harpreet Kaur. Edited by Savita Rana. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.